Hey everyone, welcome back to Financial Future, where we break down what's really happening behind the headlines so you can protect your money and prepare for what's next. Now, here's the headline that's got everyone on edge. Over $50 billion was borrowed from the Federal Reserve just last week. That's not normal. And it could be the first real warning sign that the financial system is under stress, with potential risks for your savings, investments, and even your job. Let's talk about what's really going on, why banks suddenly needed all that cash, how the government shutdown is making things worse, and most importantly, what this means for you. So here's the deal. The Federal Reserve runs something called the Standing Repo Facility. Think of it as an emergency cash window for banks. When banks need quick liquidity, basically short-term cash, they hand over safe assets like treasury bonds or mortgage-backed securities and borrow money from the Fed for a few days. Most weeks, that window barely moves. But at the end of October, something changed. Borrowing spiked by $50 billion, the highest level since the facility was created in 2021. That's a big red flag. It means banks were suddenly scrambling for cash, what economists call a funding squeeze. In simple terms, the financial system needed an emergency refill to keep running smoothly. And historically, moments like this tend to show up right before bigger financial trouble. The timing? Couldn't be worse. Washington is stuck in another government shutdown, and that's putting major pressure on the entire economy. Federal workers are missing paychecks. Families relying on food assistance are uncertain about their next benefits. Contractors and small businesses connected to federal projects are running out of cash flow. When that happens, money stops moving. And when money stops moving, banks feel it first. Imagine the financial system like a network of water pipes. If one source dries up, pressure builds everywhere else. That's when confidence weakens. People start pulling their money just to feel safe. And that's exactly how bank runs begin, quietly, before anyone realizes it's happening. This isn't just a one-week event. It's part of a much bigger trend. Interest rates are still at 20-year highs. Credit card debt and auto loan delinquencies are climbing. Households are falling behind on payments and cutting back on spending. When consumers can't pay their bills, banks lose income. Add in delayed government payments, and that income gap gets even wider. So banks tighten credit, making it harder for people to borrow, and that slows everything down even more. It's a feedback loop that can quietly spiral into a real financial crunch. We've seen this pattern before in 2008, in 2019, even in 2020 when the pandemic hit. It always starts the same way: liquidity problems behind the scenes that snowball into something much bigger. Back in 2019, banks quietly borrowed billions in short-term markets just months before the pandemic hit. And in 2008, the cracks started with missed mortgage payments and over-leveraged banks. When Lehman Brothers collapsed, the entire credit system froze. What began as a liquidity issue turned into a global financial meltdown. Fast forward to today, we're seeing familiar warning signs again. Families are drowning in high prices and rising debt, banks are short on cash, and the government is on pause. It's like both sides of the system are being squeezed at the same time, and that's what makes this moment so dangerous. So what happens next? Banks turn to the one place they can: the Federal Reserve. They hand over their safest assets and borrow emergency cash. That's why the $50 billion spike happened. It's not technically money printing, but it's close. And while it keeps the system breathing for now, it comes with trade-offs: more inflation risk, a weaker dollar, and growing uncertainty for savers and retirees. It's like patching a leak in a dam. It holds for a while, but it reminds you just how fragile that structure really is. So, what does all this mean for you? If you're retired or living on a fixed income, pay attention. Tighter liquidity can lead to more market volatility, shifting interest rates, and unpredictable swings in investment portfolios. And remember, when banks start to feel the squeeze, confidence becomes everything. Bank runs don't start because the system fails overnight, they start when people believe it might. That's why staying informed is your best defense. Watch what the Fed does next. Keep an eye on any new emergency lending programs or sudden policy changes. And most importantly, don't panic, but don't ignore the signals either. So, are we just seeing normal market mechanics here, or are these the first visible signs of another brewing banking crisis tied to the government shutdown? Let me know your thoughts down in the comments. If you found this video helpful, make sure to like, subscribe, and turn on notifications, because on Financial Future, we break down complex financial stories in plain English, so you can stay one step ahead of what's coming next. Until next time, this is Financial Future, helping you make sense of money and your future.